Black Cat Syndicate, we have been around for about 5 years and we have 2.4 million ounces of high-grade gold, just over 2.4 million ounces of high-grade gold spread across 3 different projects, all within Western Australia. So Cal East, just outside of Kalgoorlie obviously, Paulson's in the Pilbara and Coyote up in the Tanami. So Paulson's and Coyote are arguably 2 of the highest grade gold deposits going around, and they both have installed infrastructure. We have recently put out studies on all 3 of these projects. They've been out in the last month or 2. They've all got significant upside and they all show strong restart potential. Our plan is to sequentially start each of these 3 projects, starting with Paulson's and then the other 2, and get ourselves to 150 to 180,000 ounce production run rate. Here's the 3 all lined up so you can see all the key metrics together. They're ordered 1 to 3 from lowest capital requirements to the highest capital requirements. Paulson's itself just needs a refurbishment of the mill. It's 42 million to get that project off the ground. We'd like to think that once we're established, have the cash flow coming in, we can then reinvest that cash flow into growing that resource and growing that mine life, as well as, of course, putting it into starting the 2nd and the 3rd projects. And in that way, fund our way to growing to 150,000 ounces per annum. That generates strong cash flow. There's good all-in sustaining costs from each of these projects, and each of them is effectively relatively low capital. Not too much else to say on this slide, but bear in mind, I'm going to be talking to Paulson's in this presentation. Coyote and Cal East, there's a lot going on, and please come and see us in the booth if you'd like more information on those, or check out the website, but I won't get into too much detail on those in this presentation. We have just completed a capital raising yesterday, so we've got 304 million shares on market. We'll have a market capitalisation pro forma around 70 million at the moment, cash of about 13 million, and our directors have about 10% of the stock. They tipped in another 680,000 yesterday and have 8.8 million invested to date. Those directors include Paul Chapman, Les Davis, the founders of Silver Lake Resources, guys that really know how to build companies. We've got Philip Crutchfield, King's Counsel over here on the East Coast, and also on the board of several other junior explorers. And Tony Polglaze has built mills all around the world, and I'm a mining geologist. So we have a full spectrum of experience across the board, lots of experience there. So Paulson's is the asset that created Northern Star, really. They were a 2-cent explorer before they bought this. It had a very short mine life, and they picked it up and they made a lot of cash. That gave them the opportunity to buy Barrick's assets when they were leaving Australia, and the rest is history. They're a big gold miner now. But this operation presents the same opportunity for the next junior to come along, and we have it in our portfolio. So our focus is on this deposit for those reasons. We have a 1,250 kilometre land holding. It's very prospective, obviously, for gold, but also for other base metals. The well-maintained processing facility does need some money spent on refurbishment, and that's all in the study that we've put out. It's dewatered and ventilated all the way to the bottom, so we've got an underground drill rig in there, drilling, adding resource. So in 7 months of drilling, we've increased the resource 3.7 times. We're adding about 12,000 ounces every month to the mine plan, and it's a very high-grade resource, and we're very confident we can continue to do that. When it's operating, it'll be the only operating gold processing facility within a 400-kilometre radius. So it really does dominate that area. I won't talk too much to the study outcomes because we will be updating this again in the near term. So we're spending money at the moment on increasing the resources, adding to the mine plan, and reducing our capital. So these will all change. Things that weren't included in the original study was the extension to the main zone. That was a discovery we made after this. Obviously, we still need to do more optimisation work. We've got spare capacity in the mill. All of these things can help bring down our all-in sustaining cost as we go forward. This slide shows the history and potential future of Paulson's in one sort of image. So the grey area up the top is basically where it's been mined to date. 2 operators. Intrepid took out the first 400 odd metres. Northern Star came in when Intrepid sort of were losing the ore body. It had very little left in it. Northern Star came in and mined for another 7 or 8 years. So 1 million ounces taken out of this system over that time. So 1,000 ounces per vertical metre was extracted. There's obviously more gold there. Our mine plan's in that top part of the mine, another 130,000 ounces as a starter. And subsequent to releasing the study, we've got another 100 vertical metres of that main zone extension below. So that's obviously going to add a lot of resource and potential cash flow into the study. So very important, and this could keep going, who knows for how long. So we've got other opportunities which we'll talk to as well. Short mine life, I've had that query at 3 years. It's actually more than this operation has historically had on average, and it's not unusual at all for WA underground gold mines. As I said, 3.7 times increase in the resource since we've been drilling there for 7 months, and we've been drilling, obviously since we released that last resource update, so that'll continue to grow. The historic average, as I said, is about 112,000 ounces in a production plan, and we've got 130 in our current production plan, and obviously we're looking to grow that further. But if you look at the graph down the bottom, it's only ever had annually quite a short mine life, and yet it has produced, over 1 million ounces to date, and more to come. In terms of deliverability, obviously we have lots of established infrastructure. We're in the underground, we've got the mill, etc., camp, offices, everything up on surface. We've got GR Engineering doing the review on the refurbishment, arguably one of the best in the business. We've got our general manager on site, our underground manager, we've got our processing manager, underground geos. They're all in there active in reducing capital requirements, increasing mine life and growing the resource. So lots happening in this space, and we're well set up, ready to go. The main zone extension itself, if you look at the blue, is where the main zone has been modelled historically, and we've got the orange part down the bottom. So we've added another 100 vertical metres. This does need more drilling, obviously, but the potential in an ore body that's averaged 1,000 ounces per vertical metre to add another 100 vertical metres is significant. We've got good hits, and we need to keep infilling that. And the prize really probably comes when you start looking at the closer space drilling and infilling on your stope designs. That's where you start seeing some really nice grades coming through. So this is drilling in and around some of our mine plan in the footwall lodes of the main zone, and that is up plunge of the main zone extension itself. So the potential is we start seeing more of these grades follow down into that main zone extension and really give ourselves a boost. So that's the prize, and that's what Paulson's historically has delivered. Lots of drilling gives lots of high grades. Gabbro veins, we've talked a lot about that over 6 months because it's a new target for Paulson's. In the footwall of the decline and outside of the mined area are all these veins in the Gabbro. We're piecing them together. It takes time and it takes a drill position in the decline, and that's why previous operators have never bothered to drill it, because you can't block the decline. We're not operating, so we can do that. And we've got a fair bit of our mine design, 35% already in those Gabbro veins, and strong growth continuing. There's a lot that hasn't been captured. There's more veins that are coming in all the time. So that's looking very positive for us, and we continue to see more growth coming from there. Lots of potential still in the existing workings that are outside of what we've been looking at. Exposed veins throughout the mine that are high grade, have no drilling, have no resources, not in any mine plan, but you could turn out on them with a jumbo straight away, so they could potentially bring more ore in the near term. So our operational guys on site are eyeballing these things and looking at, one, can we drill any of them, and if not, do we want to start just jumbo driving them? In terms of other bigger picture targets, there's lots of exploration to happen in and around the mine itself. The hanging wall hosts several targets, but the main one here is the Paulson's East trend. It's exposed at surface with some high-grade rock chips. We've got high-grade drilling, 2.5 kilometres down plunge. And for us, this represents potential for a parallel structure that really hasn't been well tested. So you look for the thicker areas that could come into a mine plan and go and test those. It has been accessed at Galileo. There's resource there. There's mine plan that we've got around that, and we'll be looking to extend drilling out from those knowns into the unknowns. The Paulson's repeat represents a transformational target, and we had two when we started this business. We only picked up this asset just over 12 months ago, and we wanted to find the Paulson's extension at depth. So tick that. We've done that now, and the Paulson's repeat was the other transformational target. This is a parallel system about 300 metres below Paulson's. So it's the same shear that hosts Paulson's, and you're looking for the break in the next gabbro. So this represents potential for another Paulson's type system sitting parallel to Paulson's. So we've got to test that. Belvedere itself comes into our mine plan in the third year. So here we have a pit that starts up, but at the same time there's a lot of underground potential here. It's small at the moment and we haven't drilled this, but you can see with the grades, it's high grade and it's similar to Paulson's. It's a quite narrow, high grade chute. So we need to get in here and obviously drill this to see if we've got another Paulson sitting out here. It's at one end of a 2.5 kilometre long shear, and that shear has historic shafts and mineralisation along that, and we have to go and do more work on that as well. So another nice target. And there's a lot more resources around Paulson's that we have in our portfolio, as well as a lot of soils and rock chips to suggest there is a lot of discovery potential. So in terms of where we're at right now, we just raised some money and we're planning to use that money to enhance the project further. We're very close to getting to a restart potential, but we see a lot of value in just upgrading that restart plan before we launch. That'll come from three areas really. That is maximising the cash flow, and that'll come from increasing the resources, increasing the mine plan. And those areas will include the footwall zone of the main zone, the main zone extension itself, gabbro veins, all these things that I've just talked about. We'll also look at the metallurgical recoveries. We've used 90% in our study. The average historical recovery at Paulson's is 92%. Our gabbro veins recover somewhere between 95 and 97%. So you can see the potential, should we get that up, is cash flow for no cost. So we're doing work on that at the moment. And then optimising other parts of the mill. We've got an underutilised mill and we've got a lot of areas that we can improve that. Two, reduce the capital. It's already a low capital capex restart. 42 million isn't much to get a gold mine going, but there are certainly areas that we can go and improve that, and we're looking for a 10% reduction. And obviously we've eyeballed a lot of those already, and we're just doing the work on that. That'll happen over the next couple of months. Completion of the debt financing. A lot of equity markets want the debt to be finished first. Debt wants the equity to be finished first. We'll just get on with it and get this debt sorted. So that'll take a couple of months to finish the due diligence and the legal documentation. So we've already got a number of term sheets that we're reviewing. We'll narrow that down and we'll finish this. So in a couple of months' time, we'll have everything in place for an enhanced study. Once we do get into production, of course, we would expect a re-rate, as all producers do, and that's what we're all here to eventually do. The average EV per production ounce for other peer group producers is about 4,700, which means if you're producing 50,000 ounces or 100,000 ounces or 150,000 ounces, you could expect to be somewhere between 240 million and 720 million enterprise value. So that would be a massive uptick from where we are right now. So in summary, we're not doing anything particularly fancy. We're following the footsteps of other major gold producers in the Australian market in starting an old operation that has high grade and established infrastructure and getting it back into production. And potentially we can be doing that with first gold in the middle of next year. We have a low risk series of developments. So we've got 3 projects already in our portfolio, and ultimately long term that should minimise dilution to our shareholders. High grade, high margin projects is what we have, and they have low capital requirements to get going. and of course there is significant potential for re-rating this company once we do get into production. So we do have 3 other projects, and please come and see me, 2 other projects, please come and see me at the booth if you'd like more information. But otherwise, thank you very much for your time.